October 1st, 2025. A seemingly routine government funding lapse turns into the most consequential political failure of the modern era. What began as a 45-day congressional deadlock became the tripwire for a decade of instability. Analysts now estimate the initial economic shock wiped $4.2 trillion from the projected national GDP over the first 2 years alone. This isn't just about closed parks and delayed paychecks. It's about the erosion of institutional confidence, the collapse of global trade certainty, and the cascading failure of the American system itself. This wasn't merely a temporary furlough. It was ground zero for a structural crisis. Initial estimates suggested the economy was losing approximately $2.5 billion per day in direct and indirect output. But those figures obscured the real danger. The true crisis, the one that would define the decade, lay in the domino effect. The cascade of long-term failures triggered by this single catastrophic event, ensuring a decade of struggle. The tripwire event. The United States government, a massive, intricate machine, requires continuous fuel, a steady flow of congressionally approved funding to function. For years, the political establishment had played a dangerous game of budgetary brinkmanship, relying on temporary measures or continuing resolutions to avoid a fiscal cliff. However, the 2025 appropriations cycle proved different. Driven by an unprecedented confluence of partisan inflexibility and an expiring debt ceiling, the October 2025 shutdown transcended its predecessors. It wasn't resolved in days or even weeks. It was a shutdown that lasted a devastating 112 days, the longest in American history, and fundamentally fractured the core operational capacity of the federal government. The immediate fallout was severe. Approximately 850,000 federal employees were furloughed, and key government services ground to a halt. Crucially, the shutdown choked the credit flow by freezing Federal Housing Administration, FHA, and Small Business Administration, SBA, loan approvals, creating a sudden, artificial liquidity crisis. This manufactured panic coincided with a global market already reeling from escalating trade tensions, amplifying a domestic policy failure into an international economic catastrophe. The world watched in disbelief as the bedrock of global financial stability, the U.S. government, appeared incapable of funding itself. Part 1. The immediate economic contraction, 2025 to 2027. The heart of the crisis in the first 2 years was a sudden, sharp contraction in credit availability and consumer confidence. The 112-day paralysis sent a shockwave through the financial sector. The cessation of government services meant critical economic data collection, like the release of key employment and inflation reports, was delayed or incomplete, introducing a devastating layer of information risk into the markets. The lack of timely data led to institutional overreaction. Investment banks, unable to accurately assess economic health, drastically tightened lending standards. Small businesses, the engine of job growth, suddenly found SBA loans, historically critical to funding and expansion, were unavailable for nearly 4 months. Initial analysis later revealed that 1.1 million new small business loans were stalled during the shutdown period, leading to an estimated 14% increase in small business closures nationwide in the ensuing year. Furthermore, consumer confidence, already fragile, plummeted by 19 points on the University of Michigan Index, creating a deep-seated fear that immediately curtailed non-essential spending. The fiscal whiplash, uncontrolled debt spiral. The eventual resolution of the shutdown did not bring relief. It brought debt. The cost of the shutdown itself, including the back pay for furloughed workers, lost revenue from services, and the cost of restart, was estimated to be over $50 billion. More critically, the prolonged political deadlock forced the Treasury to agree to a politically expedient, non-sustainable spending package to reopen the government, which included no meaningful long-term fiscal discipline. This action triggered a sharp downgrade of the nation's credit rating, increasing the cost of borrowing across the entire economy. The interest payments on the national debt, already a substantial part of the federal budget, began to swell uncontrollably. By the end of 2027, the government was spending an estimated 21% more on servicing its debt than it was on national defense, effectively diverting trillions of dollars from productive public investments like infrastructure, education, and R&D. The promise of a stable fiscal future, upon which global trust was built, was now broken. Part 2. Erosion of American Power, 2028 to 2031. The economic instability born from the 2025 shutdown fundamentally altered the global perception of the U.S. dollar. For decades, the dollar's status as the world's primary reserve currency had been sacrosanct, backed by the unwavering stability and solvency of the American government. When that stability demonstrably failed, major trading partners began accelerating their diversification efforts. The de-dollarization trend, previously a theoretical risk, gained rapid, unstoppable momentum. Key international reserve holdings of U.S. dollars and Treasury bonds saw a cumulative decrease of 8% over a 3-year period. While this sounds moderate, its psychological impact was massive, driving a slow, steady devaluation of the dollar. American imports became substantially more expensive, causing domestic inflation to remain stubbornly high, fluctuating between 5% and 7% even as the economy stagnated. A textbook case of stagflation. The price of oil, indexed globally in dollars, became more volatile, forcing American consumers and businesses to constantly adapt to unpredictable energy costs, further constraining economic recovery. The geopolitical vacuum, security, and influence. The shutdown was seen internationally not just as a political squabble, but as a sign of irreversible decline in U.S. institutional capacity. Adversarial nations, seeing a deeply distracted and internally paralyzed America, seized the opportunity to act aggressively in their spheres of influence. Crucial diplomatic funding and military intelligence operations were hobbled by the lack of continuity in 2025, creating immediate security vulnerabilities. By 2030, a major study concluded that U.S. foreign aid and democracy promotion efforts had declined by 25% due to budget cuts and uncertainty. This vacuum was filled by authoritarian states, who aggressively pushed anti-democratic narratives and brokered new trade deals that explicitly bypassed the U.S. financial system. The lack of reliable American partnership forced long-standing allies to pursue independent security and economic policies, weakening vital alliances and marking the true end of the post-Cold War American hegemony. Part 3. Social Fracture and Permanent Stagnation, 2032 to 2035. The crisis had a profoundly unequal impact on the American populace, serving as an inequality accelerator. The working class and the poor, relying on social safety nets and timely government services, were hit the hardest by the 2025 disruption. The prolonged delay in funding for programs like the Special Supplemental Nutrition Program for Women, Infants, and Children, WIC, and emergency rental assistance meant immediate financial hardship. As the economy settled into a decade of slow growth and high inflation, stagflation, the median American household income, adjusted for inflation, failed to grow for 7 consecutive years, a stagnation not seen since the Great Depression. The wealth gap exploded. By 2035, the top 1% of Americans control 45% of the nation's wealth, up from 37% a decade earlier. Furthermore, the lack of government investment meant the decay of public infrastructure and the decline of public schools, disproportionately affecting communities already struggling. A generation of young adults, facing crippling student debt and a stagnant job market, saw their prospects for homeownership, the cornerstone of the American dream, fall to an all-time low. The crisis of trust, governance, and future shocks. Perhaps the most enduring legacy of the 2025 shutdown was the death of trust in governance. The public, having witnessed a government actively inflict harm upon its own citizens and its economy for political leverage, became fundamentally disillusioned. Voter turnout in midterm elections following the event dropped by an unprecedented 12 percentage points, signaling widespread political apathy and cynicism. This collapse of civic trust made effective governance virtually impossible. Any new attempt at fiscal reform, infrastructure spending, or climate action was met with intense public skepticism and political obstruction, rooted in the memory of 2025. The government's ability to respond effectively to new challenges, whether natural disasters, pandemics, or international conflicts, was severely compromised by institutional decay and chronic underfunding. The United States was not just less prosperous, it was less governable. The decade-long crisis wasn't a single event, but a chronic condition, a self-inflicted wound that proved fatal to the nation's potential. The fiscal cliff and credit rating. The most immediate and damaging effect was the blow to America's fiscal reputation, accelerating the nation toward a deep fiscal cliff. In the fraught negotiations to finally reopen the government, Congress was forced to pass a measure that did not adequately address the statutory debt limit, merely kicking it down the road by a few months. This lack of fiscal discipline, combined with the proven dysfunction of the government, sent a clear, negative signal to global markets. Rating agencies, already concerned by the mounting national debt, which exceeded $35 trillion at the time, reacted swiftly. The consequences were immediate and painful. Within 3 weeks of the shutdown's resolution, the country saw a historic 2-notch downgrade of its sovereign credit rating by a major rating agency. This was not just symbolic. It was transactional. The downgrades triggered an immediate, sharp increase in the government's cost of borrowing. Data shows that the yield on the benchmark 10-year Treasury note spiked by an average of 75 basis points in the subsequent quarter, directly attributable to the increased risk premium demanded by investors. The ripple effect was devastating. Higher interest rates for government meant higher interest rates for every American. Mortgage rates climbed, corporate borrowing costs soared, and the annual interest payment on the national debt, already projected to be the single largest line item in the federal budget by 2028, was locked in for a faster, more ruinous trajectory. The crisis of the shutdown had now metastasized into a structural debt crisis, erosion of critical infrastructure and services. While the fiscal damage was headline news, the shutdown's insidious effect on the nation's regulatory and research infrastructure constituted the second major domino. The government is not just a provider of checks. It is the engine of regulation, safety, and scientific advancement. When agencies like the National Institutes of Health, NIH, and the Food and Drug Administration, FDA, faced protracted stoppages, the long-term impact was severe. During the shutdown period, over 80% of grant reviews and approvals at the NIH were frozen. This resulted in a permanent cohort of research scientists, many of whom were early career investigators whose labs rely on continuous funding, being forced to shutter their operations. This brain drain from fundamental research represents a massive, non-recoverable loss of potential innovation. Furthermore, the FDA's ability to conduct routine inspections and fast-track critical drug approvals was severely hampered. Post-shutdown data indicated that the average time for the review of new drug applications, NDAs, increased by 15% in the following year, leading to measurable delays in public access to potentially life-saving therapeutics. The cumulative effect was a deceleration of the American innovation engine and an erosion of the foundational trust in public health and safety, setting back critical research timelines by years, thereby ensuring a decade where other global competitors seized the lead in fields like biotechnology and artificial intelligence regulation. Conclusion: the final domino. The 2025 shutdown was not an isolated incident. It was a perfect political weapon, a small, targeted action that detonated a massive, predictable economic chain reaction. The decade that followed proved that America's greatest threat was not external, but internal. The fiscal recklessness of 2025 cost the nation an estimated $15.5 trillion in lost opportunity and compounded debt. As we look at the stalled infrastructure, the devalued dollar, and the entrenched political paralysis of 2035, the lesson is clear. Institutional stability is the ultimate national security asset. Once broken, the domino effect is irreversible, and the American crisis becomes the new normal.